All right, let's just dive right into this. Welcome to a brand new explainer. Today we're unpacking the absolutely massive AI-driven cybersecurity boom, and we're looking closely at two sheer titans of the industry. We're going to explore how the landscape of enterprise security is literally shifting right beneath our feet. And honestly, more importantly, we'll look at how the market is reacting, or maybe completely overreacting, to the underlying fundamentals of these huge companies.
So here's our roadmap for today. We'll kick things off with the AI cybersecurity boom, then compare our two titans, and check out this radical shift in flexible bookings. After that, we'll analyze their totally diverging market valuations, and finally do a deep dive into Zscaler's fundamentals to figure out their future outlook.
Okay, Section 1, the AI cybersecurity boom and the new threat landscape.
Attackers out there are increasingly using highly creative AI-powered techniques to breach data silos, and it's forcing the entire cybersecurity industry to adapt incredibly fast. We aren't in the era of installing antivirus software from a CD-ROM anymore, right? We are in a full-blown arms race. AI detection and response solutions are surging, growing by over 250% year over year. This isn't just some minor shift, it's a massive structural demand explosion. Enterprise software basically needs to be as deeply embedded as humanly possible to stop these AI threats before they can even do anything. In fact, according to industry presentations, the entire cybersecurity sector is projected to double again by the year 2030. That is sustained double-digit compound annual growth.
Moving on to Section 2, CrowdStrike versus Zscaler and their two approaches to enterprise security.
Now, both of these companies have captured this massive demand through a really effective land and expand model. Basically, they secure an initial contract and then just continuously upsell new modules. But here's the thing, they aren't actually zero-sum competitors. CrowdStrike really made its name in endpoint security. They're essentially locking down the physical devices, laptops and remote hardware, which obviously became a huge deal during the shift to remote work. Zscaler, on the other hand, specializes in zero-trust internet access. They operate higher up, protecting the networks and cloud applications from the wider internet. So think of it like this. One locks down your physical devices, while the other acts as the ultimate bouncer for your network infrastructure. At the end of the day, most massive enterprises eventually want, and honestly need, both of them.
Section 3, the flexible booking revolution and adapting to customer needs.
Okay, so enter flexible bookings. CrowdStrike calls it Falcon Flex, and Zscaler calls it Z-Flex. Historically, if you were a big enterprise client, you had to lock into specific software modules for years. But because the AI threat landscape changes so incredibly fast now, customers push back. They just didn't want to be stuck with obsolete protections. So the industry adapted, and they created what is essentially a refillable piggy bank model. Customers pay upfront to fill up their account, and then they can just mix, match, and dynamically switch security modules as their needs evolve, all without having to negotiate a brand new contract every single time. It's brilliant. And get this, the adoption rate of this model is just staggering. Zscaler saw an explosive 600% year-over-year growth in these Z-Flex bookings, climbing from just $65 million to reaching $480 million in their third quarter alone. CrowdStrike has seen a really similar massive adoption, with Falcon Flex up 99% year-over-year to $2 billion. It's a total win-win situation. The customers get ultimate flexibility, and the cybersecurity companies get massive committed upfront capital. Which brings us to Section 4, a divergence in valuation. This is a tale of two stocks, and honestly, a true Wall Street mystery. So both of these companies are deeply embedded in the enterprise, right? Both are seeing massive structural demand, and both are successfully pivoting to these flexible bookings. Yet their stock charts look like complete mirror opposites. CrowdStrike stock has been on absolute fire, up 53% year to date, but Zscaler stock, it's actually declined 40% over the exact same period. And short interest, so investors actively betting against the stock, has steadily spiked to nearly 11%. The shift in how the market values these two companies is staggering to look at. CrowdStrike is currently trading at a massive premium of 36 times sales. Meanwhile, Zscaler's multiple has contracted dramatically over the last year, dropping all the way from 18x down to just 7x. So CrowdStrike is getting way more expensive, while Zscaler is getting significantly cheaper. The big question we have to ask is, why? Is Zscaler a broken business?
Let's find out in Section 5. Deep dive into Zscaler fundamentals, looking under the hood.
If we cut through all the stock market noise for a second and just ignore that plunging stock chart, the actual data shows Zscaler is actively accelerating. In their latest quarter, revenue grew 25% to over $850 million. Total annual recurring revenue, or ARR, is up 25% to a whopping $3.5 billion. They are now literally securing over 45% of all Fortune 500 companies. And their AI security pillar, which is going to be a massive future growth driver for them, grew over 80% and absolutely crushed its $400 million target 3 quarters early.
This level of operational efficiency puts them in a super elite status. For the jargon busters out there, the software industry uses something called the Rule of 40 to measure a company's health. Basically, if your revenue growth rate plus your profit margin equals 40 or higher, you are doing fantastic. Well, when you add Zscaler's massive 52% free cash flow margin to their 26% revenue growth, you get a Rule of 78. That makes them one of only 5 enterprise software as a service companies in the entire world operating at this elite scale and efficiency. 5. Now, if you really want to find a flaw, the only slight blemish we could spot was a minor dip in their Q3 free cash flow margin, which went from 18% down to 16%, while the free cash flow itself only grew 8% year over year. However, management directly attributes this to the timing of cash collections related to those massive new flexible bookings we talked about, rather than any fundamental loss of business or rising costs. So it's really just a working capital quirk, definitely not a core structural flaw.
Let's wrap up with Section 6, Zscaler's future outlook, fear versus fundamentals. Okay, so if the business is operating at an elite level and the metrics are this strong, why the massive sell-off? Well, it ultimately comes down to Wall Street's fear of the future. The crucial point is how management communicated their long-term vision. A couple of years ago, Zscaler acquired a company called Red Canary to focus specifically on AI security agents. Recently, management issued a highly conservative 15 to 16% growth forecast, looking all the way out into 2027. They specifically cited some uncertainty around how fast Red Canary's net new annual recurring revenue would scale compared to their core business. Wall Street, who was expecting a continuous 25 to 30% growth narrative, just completely freaked out at the sight of that 15% number. But, as always, context is absolutely everything. As industry analysts at 7 Investing note, Zscaler is kind of notorious for sandbagging, meaning they purposefully set a very low bar that they know they can comfortably clear and exceed quarter after quarter. In fact, right now, that very same Red Canary acquisition is actually exceeding their internal expectations. They recently raised its full-year revenue guidance from $125 million to $136 million, so the fear in the market simply doesn't match the current facts on the ground. When we look at the ticker valuation models projected out to 2026, the potential upside becomes incredibly clear. Even in the absolute lowest case scenario, where revenue growth slows to 17.6% and margins compress, the stock still projects a massive 58% total return over the next 2.5 years, based on its currently depressed multiple. And in their mid-case scenario, you're looking at a 112% return. The fundamental math highly suggests the market has vastly overcorrected here. So I want to leave you with this final, provocative thought to consider today. Is Zscaler's contracting multiple a justified panic, or is it the ultimate buying opportunity? We've got 2 companies, CrowdStrike and Zscaler, both dominating a booming sector. One is priced for absolute perfection, and the other is priced as if the sky is falling, despite operating at a Rule of 78 elite status. When a company's underlying engine is running this smoothly and generating this much cash, could a short-term market panic driven by conservative guidance be exactly the kind of setup that long-term investors dream of? Well, that is something you're going to have to decide for yourself. Thanks so much for joining me on this explainer, and I will see you next time.